Hello, my name is David Hillier, and I will be giving just a short video on an introduction to external financing, the different types of external financing that companies can take, and also a little bit about the financial markets. This video is for my students at the University of Strathclyde, and the slides will come from my textbook, Financial Markets and Corporate Strategy. Now, when a company is looking to raise capital for an investment, they can really take from two main sources. One is from internal funds, and internal funds are those that have been generated from the existing operations of the company or via past investments of capital into the firm by owners or by lenders. So internal capital is all about what the company already has. If the company does not have enough capital or cash in the company to fund the investment they wish to make, then they need to consider going outside the company and to engage with potential investors to raise those funds. And this is what this lecture is all about. When we talk about financing, I really want to make it clear that the patterns of financing across the world are very different. And this comes down to culture. Again, I keep on talking about culture in my videos, but I really do believe from all my trips about the world that and engaging with business people in all parts of the world, that the culture of the environment really influences the decisions that managers make, and even past experiences influence decisions that managers make. So we've just come out of a financial crisis. So what have we been seeing? Well, we're seeing companies hoarding more cash. Why? Because liquidity dried up. So here's an example of past experience affecting decisions that people make just now. Now I want you to look at this this graph here, and this comes from Beck et al. 2008. The reference is in the textbook, and it looks at external versus internal financing in different countries. The external financing is the light grey, and the dark grey is internal financing. You could argue that the size of the external financing is a direct relationship, has a direct relationship with the efficiency of the financial markets. The idea is that if the financial markets are more efficient, then you would expect to see greater proportions of financing coming from external routes. But we don't tend to see that. If you look at this, and you can see that, it ranges from Armenia, which has very low levels of external financing, all the way through to Italy, that has very high levels of external financing. So you can't really put that, the efficiency of the financial markets as being a major factor. You can look even, in like there's Sweden. Sweden sits next to Pakistan. Where are the commonalities between those two countries? You then can go to the left-hand side and you see China and Venezuela together. You see United States sitting next to Singapore. It sits next to Canada, which you could argue is geographically close, so you wouldn't expect to see much of a difference there. So, it really is, it's difficult to try and pin down the main reasons why we have different patterns, and I believe that it's because of past experiences and this nebulous concept of culture. When a company is thinking of going outside to raise capital, we can look at a number of different areas where that capital can be raised. And in this exhibit here, I split it into two main areas: debt and equity. And then if we think about debt, What type of external capital can be raised that are as debt instruments? Well, bank loans, going to the bank, borrowing money from the bank, issuing bonds to the public. Supplier credit. Supplier credit is where you purchase goods and then you enter into a contract to pay for those goods in about 3 months or 90 days, 180 days. That is a form of credit. It's a form of external capital. Why? Because you are receiving the goods without actually paying for them. So that is a loan. And individuals, we enter into supplier credit or trade credit contracts when we, for example, buy a car on hire purchase. We get the car, but we don't actually pay it up fully for a number of years. A lease is just borrowing, renting an asset. Again, renting the asset, you're not purchasing it, so it is a substitute, it's a form of external capital. And research has shown that a lot of companies substitute debt by taking out lots of leasing. And then you have informal sources of debt. And you see informal sources of debt predominantly in emerging markets, such as China and the majority of Africa. If we then go into equity, you have ordinary shares. That just gives you an ownership, part ownership of the company. You can have preference shares. Now, preference shares are a hybrid security that combines debt characteristics with equity characteristics. The equity characteristics are that you give up ownership, but the debt characteristics is that there is a commitment, but not a binding commitment, to pay a fixed dividend, which is equivalent to, it's equivalent in nature to an interest coupon, but it is a dividend, and so it has a debt characteristic there, but it also has equity characteristic. Warrants are securities that if you exercise those securities, the company that issues a warrant must issue new equity to you. And then again, informal sources of equity is investment from families. Again, very common in emerging markets. This comes from Beck et al., same paper, 2008, and this is now breaking the external financing down into the different groups. So external financing is 11.42%. How is that made up? Well, it's made up from, like, say, banking. You've got equity, you have leasing, supplier credit. Development bank is something which is unique to certain parts of the world where some public organisation invests in company, and then you have informal financing. And I want to point you just to a number of kind of fairly, I think, are quite important differences. I want you to look at China first. If you look at China, you'll see that the second most common form of external financing is informal financing, and that is quite, that is really quite a significant thing. That, in China, after the banks, informal types of financing are the second most are the most common. So more common than, say, equity markets. So if you're brought up in the UK or Europe or the US, and you're thinking, well, if the most common type of external financing is the stock market, because that's what we're used to. In China, that's not the case. In China, the stock markets come after development bank, public sector investment, and it is equivalent to supplier credit. If you look at Italy, you see that 50% of all external financing comes from the banking sector. That shows you how important the banking sector is in the Italian corporate environment. If we go to the US and the UK, you see that the UK, the banking sector is the most important, followed very closely by the stock market. The stock market in the UK is incredibly strong. When you divide the stock market capitalisation by country GDP, the United Kingdom is the largest country, or has the largest stock market in the world when you standardise by GDP. So that's how important that we are as a country if you are British. If you take the US, you see that the US, a lot more financing coming from the banking sector, and equity is it's not as you would maybe expect it to be, is in terms of the level of activity there in terms of that primary market. So this paper, I would definitely encourage you to go to Beck et al.'s paper in 2008. The full reference with page numbers, etc., is given in the book. That's Financial Markets and Corporate Strategy. So, we've seen how things vary across the world in terms of financing. What we say works in the US might not work in the UK because, again, the environment is different. Although we think that the corporate environments are very similar, that we're market oriented, but really there are differences that you can't capture. This slide, just what it does is it compares the stock markets. And you've got NYSE Euronext. Now you'll notice that NYSE Euronext appears twice. It appears, it's got US and it's got Europe. That's because NYSE and Euronext merged. So the New York Stock Exchange is NYSE. That's the largest stock exchange. Sorry, that's the largest stock exchange by a long mile in the world. You've got Tokyo, Nasdaq. Nasdaq again is another stock exchange. Has a lot more tech companies there. You've got the London Stock Exchange, and then you have Euronext. Now, so Euronext is the combination of Amsterdam, Lisbon, Paris, and Belgium, I think, Brussels. Combined, the London Stock Exchange is larger than all of those exchanges. And as I said, if you divide the value of these exchanges by country GDP, the London Stock Exchange is by far the largest. Notice the Chinese stock exchanges coming after. Then you have Toronto, then India, then you have the Brazilian Stock Exchange. That's the BM plus F Bovespa. Okay, so that's an overview of the different sizes of the stock markets. I'm now going to just spend a little bit of time talking about regulation. I'll talk about the US regulation, the Sarbanes-Oxley Act, which is called SARBOX or SOX. That came in 2001 in response to the big collapses of Enron, WorldCom. It's a very strong regulation, and it forces, or what it does is it significantly increases the accountability of senior executives in the company. It significantly heightens the level of disclosure that companies must provide to investors. And it has a number of areas relating to the audit committee and governance that has really impacted upon the way in which companies behave. Because so many companies operate in the US, even though they're not they don't originate in the US. So, say for example, a European company, Telefonica, or any really large like BMW, because they have operations in the US, then this act has actually affected them. So this is something that this regulation really, it was introduced more than 10 years ago, but it still has massive implications for doing business in the US. I've got in the last box here regulatory versus comply or explain, and the Sarbanes-Oxley Act is regulatory. Basically, it says that companies must adhere to the principles that are in the Act. If you do not adhere to them, you're going to be committing a crime. This is very different from the way in which the British approach to regulation is structured, because especially with corporate governance in the UK, it's you must comply with this. But if you don't comply, then you must explain why you don't comply. Um, and that is, with all our governance regulations in the UK, we have that particular characteristic. Europe is more regulatory, and so Europe has that, mandatory adoption of regulation, which you see throughout Scandinavia and Europe. And at the moment within the European Union, where really are conflicting between the UK, which has this system of complied explaining governance, and the mandatory regulatory approach, which we see in Europe. And this is an ongoing issue. So the UK system is it's a UK Corporate Governance Code. We do also have the UK Stewardship Code, but the Governance Code has combined everything. If you're wanting to read into these codes in a lot more detail, if you want to check out codes for your own country, then go to the website ecgi.org. It's based in Europe, and it has all the codes for different countries. It also has a lot of really good research by top academics in the area of corporate governance. So, very quick overview of external financing. Hopefully it gives you an insight into the way that things are different across the world, and in future videos we'll go into these areas in a lot more detail. Thank you very much.